Let's talk about the 800-pound gorilla in the room, and I'm talking about interest rates. Interest rates have been a key driver of the economy since the pandemic. Along with a bunch of stimulus being pumped into the market, the Feds lowered the Fed funds rate, which ultimately lowered interest rates, which allowed for cheap borrowing, and it allowed buyers to borrow at super low interest rates, which ultimately pushed housing prices higher and affordability became more of an issue. But over the last couple of weeks, what we've seen is interest rates rise. We've seen the 30-year fixed rate go up anywhere between 0.3% to 0.5%, which is a pretty substantial amount. So what does that actually do for the housing market? Does that create a housing market crash? Does it create stability? Well, in today's video, we're going to talk about it in a little bit more detail. We're going to talk about why we've seen that rise in interest rates over the last couple of weeks, what we're likely to see moving forward towards the end of the year, and how it actually impacts the housing market. Right now, everyone is afraid that inflation is grabbing a toehold on the market and the Fed isn't doing anything about it, which has created a bit of anxiety in the market, causing interest rates to go higher. But recently, we've heard the Fed talk about taking away the punch bowl in the sense of buying mortgage-backed securities and bond purchases at $120 billion a month. But until it becomes clear that the Fed's actually going to taper and then follow through with it, you're not likely to see any real improvement in interest rates. But I do believe as they start to taper, they follow through with everything and start to limit the number of bond purchases and mortgage-backed security purchases, that you're likely to see a small improvement in interest rates. Now, what does that actually mean? How much? It's hard to say at this time, but I do believe the recent rise that we've seen is because of people worried about inflation and the Fed not doing anything about it. So how will rising rates actually affect the housing market? What have we seen over the last couple of weeks? And what are we likely to see over coming months if interest rates stay where they are, rising by 3/8, 0.5%, or possibly going higher? Well, that's what we're going to talk about right now. Before we dive into that, though, I want to take a minute and introduce myself. My name is Jeb Smith. I'm a real estate broker here in Southern California. My channel is all about real estate. If you find any value in this content at all, do me a favor, give me a thumbs up. And if you think I'm crazy, give me a thumbs down. It's okay, but I'd love to hear your comments below. So if you have any questions, put them there and we can have a conversation. So over the last couple of weeks, we've seen interest rates rise, as I mentioned just a moment ago, but we haven't really seen the market slow down, at least here in Southern California. Now, a lot of times when I talk about the housing market, I'm talking about my local market, right? All real estate is local. You might actually be experiencing something different in your housing market than I'm experiencing here. But what I can tell you in my market is every offer I'm putting in, still multiple offers, still a lot of people out there bidding. Clients are paying above the asking price in many cases, and it's still competitive, right? It's not an easy housing market by any means. I'm showing buyers a lot of property. By the time they call me and want to see something, a lot of times the property that they're looking at is already in escrow. And I can tell you from my own experience, looking at a property with my wife last week, we're actually looking to purchase something, and by the time we saw the property, which was one day after coming active on the market, they already had 4 offers. And this isn't an inexpensive piece of property. At the same time, this is also a property that needs a lot of work. It needs to be completely rehabbed, remodeled, right? So not only are people putting in offers at a high price, but they're also expecting to spend a lot of money on it to remodel it. So at the moment, we haven't really seen any slowdown in the housing market. But if we do see rates continue to rise, what you're likely to see is you're likely to see less people refinancing, right? Refinancing is not going to be an option because a lot of people already have low interest rates out there. They're not going to be able to take advantage of that. I think that translates into less second home purchases, possibly less investment purchases, because a lot of times people are pulling money out of their properties to buy second homes and investment properties. And if they can't refinance at a reasonable rate and pull that cash out, a lot of people just aren't going to take advantage of that. So that means less competition on that second home and possibly in the investment market as well. Now, a lot of the investment buyers at the moment are big hedge funds, big companies, and we know that Zillow's put things on hold. Now, there's a lot of beliefs on why Zillow did that, but they came out and said that it's primarily due to a lack of employment, a lack of people willing to work, and they've purchased a lot of property, and a lot of that property needs work done to it, and they don't have the workers to be able to facilitate it. So therefore, they're not continuing to buy property, which takes one of the major iBuyers out of the market. But The other players like Open Door, those guys have said they're going to continue to buy property. So it'll be interesting to see what happens to investment property over the next couple of months leading into next year without one of the major players in it. That's neither here nor there at the moment. So how do interest rates continue to affect the market moving forward? The first thing I believe is that rising interest rates are going to affect affordability, right? There's a lot of people, at the top end of their budget when it comes to buying a house. If interest rates continue to rise, those buyers are going to get priced out of the market, right? At least at the price point that they're currently looking. So they either have to settle for something less expensive or wait for the market to change and potentially pull back for them to get into the market. With less buyers in the market, what you're likely to see is inventory levels pick up, more supply in the market. Now, more supply doesn't ultimately mean a housing crash. It doesn't mean a crash at all. It could mean more stability in the market. It could mean properties not appreciating at the rapid pace that we saw last year, right? Which is welcomed as a real estate agent. That's something I'd love to see. I'd love to see normal 3 to 5% appreciation, which is more or less what Fannie Mae came out and said. But at the same time, you have, Goldman Sachs saying 16%, Zillow saying 12% appreciation next year, which isn't healthy for the market, right? We need some stabilization in the market. So I think less demand means more stabilization. It doesn't necessarily mean some pullback in price. But what I will tell you is that if you do see a pullback in price, those buyers that have been priced out of the market are now likely to become buyers again, right? They're more likely to put in an offer because they don't want to miss the boat. At the same time, as I mentioned a moment ago, I'm a buyer looking for property. If interest rates continue to go up, I'm probably no longer a buyer again, at least temporarily, because, until interest rates rise enough that it completely stalls buyer demand, where supply rises, right? Not just, stays the same, if you will, but enough supply on the market to actually drop prices, I'm not likely to go out and spend substantially more money for a home, with rising interest rates, right? I'm already going up in price, which is going to, my mortgage payment's going to go up, my property taxes are going to go up. And if interest rates continue to rise, that means that my mortgage payment's going to go even higher. And I'm already at a point where I don't want to spend that money because I'm comfortable where I am right now, right? I bought my house in 2012. I paid quite a bit less for it than it's actually worth. I have a great interest rate on that home, and therefore I'm very comfortable with regards to the mortgage payment. And so if interest rates rise, I'm less likely to be a buyer at that time. And I think you're going to have a lot of buyers out there, even if they're not going substantially higher in price, maybe they're just making an even trade, maybe buying a little bit more, going from a townhome to a condo. It's a little bit more expensive with regards to the prices. If interest rates go up because of where they've locked in their current loan, in the 2% range for a lot of people, the high 2% range, these people are less likely to want to lose that 30-year fixed payment at that low rate and go to a substantially higher rate, right? So that's going to keep supply off the market. So you're not really likely to see any huge changes, at least temporarily, with interest rates going higher. It's going to take some time for that to work through the market. It's going to really have to affect buyer demand, right? It's going to have to affect buyer demand for quite some time in order to build that inventory enough where prices start to drop, not just stabilize, but drop. Across the US, I think we're sitting at somewhere around 2.5 months supply of homes. A balanced market is somewhere around 6 months supply of homes. So we need supply to double and then almost double again to have a balanced market. That means buyer demand really has to dry up for that to happen over a short period of time, which is not likely to happen because a lot of buyers out there at the moment aren't capped out on affordability, right? Some can spend much higher than what they're willing to pay because, they're comfortable with the current mortgage payment. They don't want to spend anymore, right? They've budgeted for a certain payment and therefore they don't want to spend anymore. But what I can tell you with working with buyers, my entire career is that once buyers go up in price, rarely do they ever come back down. So if they start seeing properties that are priced at, say, $1 million, and those properties get them, 4 bedrooms, 3,000 square feet, yard, a pool, or whatever, they're less likely, even if rates change, to say, you know what? I don't need that anymore. I'm now willing to go to a condo or a townhome, or I'll take the 3-bedroom in the different neighborhood that needs all the work. Not likely to happen. Once buyers go up into a higher price point, they check more items off their list, and then it becomes emotional. They don't want to go the other direction. So those people are less likely to want to buy less expensive homes. And in most cases, they will say, you know what, I'm going to raise my budget a little bit so that I can get the home that I want. But it's really hard to say what's going to happen over the next couple of months. Now, as I mentioned earlier, I think as the Fed, comes out starts to taper, does what they say they're going to do, you're likely to see, interest rates stabilize. You're likely to see yields come down because, the Fed is showing the market that, hey, we see that there's potential inflation. We're trying to do something about it, which is a good thing for the market. Right now, what the market sees is that the Fed's just letting it run wild and that maybe they don't have any clue as to what's going on. And therefore, the market is reacting to that. They're scared. Now, with that said, you've heard me talk about, interest rates being in a 40-year downtrend, right? Since 1982, interest rates have headed down. Until you see a break in that trend, the trend is your friend, they say, right? Until you see a break in that trend, you're not likely to see any real change in interest rates. Now, you might see rates move, again, 0.25%, 0.5% here and there, but I don't think you're going to see it stay, right? It's not going to go above 4%. I think what's more likely is you're going to see rates stabilize, probably somewhere around where they are at the moment, 3 3/8%, maybe even 3.25% over the next couple of months, right? And let things shake out. Let's see what the Fed is willing to do. Let's see how it affects inflation. What are the inflationary numbers as we move into next year? Because that's really what's driving interest rates at the moment is this scare of inflation. And so until we see whether or not this inflation is truly transitory, you're really not likely to see interest rates trend way lower. Now, a lot of people out there, a lot smarter than me, believe that you'll actually see interest rates lower than the lowest levels we saw last year. Now, they're not saying whether it's going to be 6 months out or a year out, but they do believe because that trend has been going down since 1982, you're likely to see lower interest rates at some point in the future. Now, with that said, if you're somebody out there in the market right now, you're buying a home, you're looking to, lock in an interest rate, what I would tell you is that you should probably lock it in. Less floating in this environment, right? There's too much volatility in the market. There's too many things happening to worry about the direction of interest rates. If you are comfortable with the payment that you're being quoted, I would say lock it in, right? Less likely to wait a couple of weeks and see what happens in the market because you could end up, paying a higher rate. And in my experience, what happens is as rates go up, buyers say, well, I should have locked it, when I had the opportunity. Now is that opportunity if you're out there looking, right? Lock the rate, stop looking at it, and move on. And then if rates do trend down at some point in the future, you have that opportunity to potentially refinance and lower that payment. So in summary here, I don't really think this rise in interest rates is really going to impact housing at the moment. I think if anything, it just provides a little bit of stabilization. It keeps less egregious sellers out there from shooting for the moon with regards to price. It maybe tames buyer demand a little bit, but you're not likely to see any big reduction in home prices because of those rising rates. But if you're watching this and you're wondering how rising rates could affect housing prices, check out this video here. I talk about it in more detail. I give you some examples. But for now, I appreciate you taking the time to watch. I appreciate all the support. Hope to see you again soon. Have a great day. Bye-bye.